All right. Hello, everyone. Happy Monday. Welcome to our weekly market check-in here with myself, Greta Wall. I'm your host, and I'm joined by Derrick Oldensmith, professional trader with T3 Trading Group and the leader of T3 Live's ProDesk virtual trading floor. Derrick, happy Monday. Let's quickly take a look at Derrick's current positions before we get into any market discussion. As I mentioned, he is a professional prop trader with T3 Trading Group. So this is what he is currently in as of just a second ago. Title of our stream today, Derrick, is Tech Boost, and we were getting a tech boost until we saw quite a turnaround here. Talk about how you've navigated this Monday so far, coming in obviously a very long the market. Talk about what you've been doing today and this drop that we've seen in the market today.
Sure. So I am net long the market, but I wouldn't necessarily say I'm very long the market. I have a lot of long positions on, but I have some shorts on also, and I have higher concentration in those shorts. So when we were first gapping up this morning, I was actually almost market neutral with the shorts I put on. As we've come down and filled the gap, I have added back into some of my longs that I had sold at the open and pre-market, and have bought back on some of the shorts that I had added up there. So we are now small positive. So we gapped up pretty big this morning. We gapped up a couple percentage points. About 5 minutes before we got started, the market had basically just filled its gap. The Qs ticked negative. The S&P didn't get quite there, but it got close. And the IWM also certainly got negative. This market is really tricky. It's really tricky to navigate right now. Maybe I could throw on a screen share and we can have a couple
definitely
look at a couple charts.
Mm-hmm.
Cool. Right. Am I up?
Yep.
All right, one quick second because I'm managing positions as we're talking. All right. So here's a 5-minute chart of the SPY. Just while I have it up, we had a really big gap up this morning. That gap up got sold. That's normal. The type of gap that we had this morning is called a common gap, and common gaps have a very high probability of getting filled, or at least getting partially filled. So what I said to the team in the morning meeting today, kind of our game plan was quick shorts off the open because of the upside extension from the gap, and then potentially that can lead to more like medium time frame longs, as long as we don't close below Friday's high. If we close below Friday's high, I think that this market is a technical problem. So now switching over to the daily chart, you can just see the month of April so far has been one of the craziest, if not the craziest month that I have ever traded in my career. To kick us off, we had our big liberation day on April 3rd, where we were liberated of all of our money if you're long the market, because it led to the fastest two-day down move, or the fifth fastest two-day down move since 1960. Monday, we had a massive gap down. That marks our low so far. So that's SPY 481.80, or if you want to look at the SPX, crazy, you almost can't even see the low of that candle, 48.35. So on that Monday morning, I was yelling to the team that we really need to come in and be big buyers, because we were having a day 3 gap down after the biggest 2-day sell-off I've ever seen in my entire career. That includes COVID. And we were gapping down again on that day 3. I mean, I'm a big believer in extension rules in the market, and this was literally off the Richter scale insofar as downside extension. It was the most downside extended I've ever seen the market in my entire career. And there's so many headlines out there. There's so much information that you need to digest and learn from the macro. But at the end of the day, break it down to the technicals. And when you're having that day 3 gap down, which was Monday a week ago, on the most extreme downside extension that I've ever seen, you basically have to come in my opinion, and be a buyer on that. And we were. And the theme of last week that I said over and over and over again to the team is be greedy, don't be stupid, because this market is a problem, obviously. So if you're taking any trades, long or short, there's so much volatility out there right now. The number one initial focus as soon as you enter that trade should be to get your risk covered. Put yourself in a situation where your worst case scenario means that you don't make anything and you don't lose anything, that you get a nice fat zero at the end of a failed trade if you can just get a little bit of movement in your favor. But once you've got that risk covered, then you can look to be greedy. We could get a bounce all the way back to the 8 EMA, if not the 21 EMA, if not a retest, and I'll go back to the SPYs, if not a retest of where we broke down from, which is 550. So 550 was like my ultimate reach target. When at Monday lows, we were at 482 basically. So this is basically a $70 bounce for my reach target. We caught the entirety of that. I mean, obviously, the Trump pause on Wednesday of last week certainly helped. And then, I mean, this market's just been so crazy. And then on Thursday, we were down almost 7% at one point intraday. We were down 7% for the NASDAQ at one point intraday. So like, you know, the worst 2-day move, fifth worst 2-day move since 1960, followed by like the second best day in market history, followed by a day where we almost went circuit broken because we were down 7%. We almost had to halt the market on Wednesday just for Friday to give us a little bit of a recovery. And then, as you were saying, over the weekend, we had sort of positive headlines, but they're just so murky. We got the exception for phones and semiconductors kind of announced on Friday evening, but by Sunday they were already walking it back. By Sunday they were like, no, these aren't real exceptions. These are just temporary exceptions while we figure out exactly what we want to do. The market's still at a positive read through on that though, because it's like if they're even putting any other things into a bucket, there's hope there that this gets treated differently compared to everything else. So it led to the gap up this morning, and that gap up has been sold a little bit more than I thought. It seems to me like right now this market from the bigger picture is still doing what it can to de-risk into these up moves. But with that said, I would describe myself as like intermediate term bullish right now. We're in a really tricky spot because we have bounced back huge from lows. Headlines are moving this market every day, every hour. You almost don't even know what's going to get said. I mean, it was interesting. Donald Trump was just speaking, and the market started selling off into him speaking because the market's so afraid of what he's going to say now that they're selling off before he even starts talking. And, you know, we got through it. His speech, it doesn't sound like it was terrible. And now the market's working its way back up. This SPY 550 is a hugely important level. This is the level that we were holding before we broke down on Liberation Day. And now it's the level that is holding as resistance. It's a huge level. I think, and this goes back to me being kind of intermediate term bullish, that we could test that 550 and potentially break it. If we break that 550, I think it's just going to cause a market squeeze. The people that are short are going to get squeezed out even further. There's going to be some forced buying that comes in that could give us a nice overshoot back to this 560, 570 area. But bigger picture, I am not bullish. Bigger picture, until information changes, there has been a tremendous amount of destruction that has been done to the U.S. economy on the big picture. And I think it's just going to be a matter of time before we see that in growth and inflation numbers. So small picture, we can really continue to get some bounces here and break higher. Bigger picture, as these economic numbers come out and they read through from companies that are reporting earnings but can't give guidance because they don't even know how to guide because they don't even know what tariffs they're going to be giving. I keep talking about this over and over and over again. Imagine being in the C-suite of an S&P 500 company right now and you're responsible for corporate strategy. How can you do corporate strategy when you don't even know what the input costs to your business are going to be? You can't. How can you give guidance? So we're probably going to see in this earnings season that's just getting started, a lot of companies that withdraw guidance, and that is traditionally very bad for the market. And then eventually we see the read through in the economic numbers insofar as a growth slowdown or inflation picking up, and that just makes it very, very difficult to be big picture bullish for more than a tactical bounce, which is what I'm looking for currently, until we can get through this tariff nonsense and see if this is something that can improve or if this is something that just leads to, you know, broader destruction of the U.S. economy for a longer period of time.
All right, I want to talk about the last time you were live for the T3 audience was last Wednesday during the roundtable with you, JR, Sammy, and Mike. You were very bullish. And it was pre the best day ever for the market. And before you guys called the bottom, and
It
you
was
guys got
the
it right.
best day ever for my career, also,
So
for whatever
I want
that's
to talk
worth.
to you. I want to ask how was last Wednesday for Derrick as the trader, and how do you, coming off a day like that into a day like Thursday, how do you make sure you're not cocky on Thursday and you don't just give back all of the gains because you think you know the market better than the market? How was
Sure.
Wednesday?
So on Wednesday of last week, it was interesting. I was doing the thing that we do on Wednesdays with Sammy and JR and Mike Camo and the audience in there. And I remember Mike Camo writing or saying a question to the audience. And the question to the audience was, if you are a buyer of this market right now, press 11 into the chat or whatever. And I, out of curiosity, snuck over into the YouTube chat, and I saw that not a single person put 11 in there. There was like a couple 22s, but there were no 11s. And I came out and I was like, look, I'm a buyer here, because it looked to me on Wednesday morning before that announcement came that the Trump put, which has been something that's been discussed, right? Everyone is aware of like the Fed put, which is basically at a certain point on the downside, the Fed steps in and saves the market. Well, there's been a lot of chatter for over a month now about where is the Trump put? At what point does he, begin to break down? Because up until Wednesday of last week, he has, publicly expressed his disinterest in the stock market. He doesn't care if the stock market goes down. He says it's not time for Wall Street, it's time for Main Street to succeed. And, okay, sure. But at a certain point, I think, 60% of Americans own stocks. A lot of people have 401ks. A lot of people have IRAs. People who are retired are trying to live off their savings, and the savings are invested. So Wall Street and Main Street, to some degree, certainly walk hand in hand. But that morning, we started to see him begin to pivot a little bit. He was like, oh, you know what? I'm going to quietly allow this NVIDIA chip to get sold to China. And then he literally went on Twitter or whatever and said, I think it's a good day to buy the dip. And at that point, we're also still very, based on my metrics, extremely extended to the downside. So I'm like beginning to see the inkling that morning of Trump begin to cave basically on some of this tariff stuff. I mean, he literally said himself, it's a great day to buy the dip. And the market's extremely extended. So I had 0 shorts on Wednesday in the middle of the day. I had a lot of longs on. And then when that headline came out, we got the move. And it's not a coincidence where we stopped. The high of the day is almost SPY 549. SPY 550 is the massive level that I was talking about. It's the level on Monday morning a week ago on that huge gap down that was my reach target. So I was just selling the entire way up. And then instead of, and it did turn into the best day of my career, but instead of, to answer your question, like getting big headed about that, for me, it was about, now we have a narrative shift. And I'm taking what I'm about to say from a Goldman Sachs research note. I read a research note from Goldman that broke down different types of bear markets. And I had never seen it broken down in that way before. So it was educational for me. And by the way, that's one of the things I love about this business, is that I've been doing this for 15 years, but I'm still learning things. And they basically describe that you have such thing as an event-driven bear market, you have such thing as a cyclical bear market, and you have such thing as a structural bear market. The bear market that we have been in is an event-driven market. We got a new president of the United States, and he decided to make some really, really big changes. Amongst those changes were tariffs. And tariffs, like I've been saying for months and months and months, are inflationary by nature and slow growth by nature. And that came as such a shock to the market. Not even just the fact that he did tariffs, because he literally campaigned on them, but it was the degree of the tariffs. The numbers that he said that Wednesday a week ago, first of all, they're not even the correct numbers. They're not actually true retaliatory tariffs. But those numbers were so extreme, they were beyond the imagination of pretty much everybody. And it created an event-driven bear market. Everyone freaked out. Oh my God, something is changing. The normal status quo of how the market has traded for the last 100 years is changing based on this announcement. And you had this event-driven market. Well, that event ended, maybe not fully, but that event ended to some degree on Wednesday last week. when Trump said, all right, now the tariffs are going on this 90-day pause. And now we have to see over the course of the next 90 days, do we get a second event bear market as we approach the next deadline, or over the course of these 90 days, do things cool down a little bit? But the real question that I posed in that afternoon meeting, as I was staring at this nice, big, juicy green P&L, I was saying to myself, I was like, all right, the event-driven bear market for the moment seems like it's over. The question is, does this now morph into a cyclical bear market? And a cyclical bear market is going to be defined by basically slower growth. So if you have a market that is just, the market trades on a PE multiple. I think I'm not educating anyone when I talk about that. I'm a big fan of looking at the forward PE multiple personally. And we know that when the forward PE of the S&P gets into the low 20s, you're a little bit expensive. When you're at like 18, 17, you're probably a little bit more normal. And then if you get to like 14, 15, 16, then you're like historically very cheap. And that PE multiple, it's a price earnings multiple. It's based on the expectation for growth. So the market can trade at a more expensive PE, or a stock can trade at a more expensive PE if there is a lot of expectation of further growth. But if all of a sudden something comes up, which in this case is tariffs, that indicate that we will get slower growth going forward, then you get less earnings, and you also at the same time get multiple contraction. So it's like a little bit of a double whammy. So the question that I posed to myself on this Wednesday was, all right, great, we got through the event bear market, but does this now lead to a cyclical bear market where we get a compression of that multiple and we get slower earnings over the course of the next 6 months, 1 year, or possibly even several years? All indications for the moment point to that being yes. So in the same vein as with this morning's gap up, where the market participants seem to be using any of these larger up moves as opportunities to de-risk on long exposure, I'm kind of doing the same thing. So it was Wednesday into the close, I was like, all right, I'm going to start putting some shorts on. I'm going to, short Palantir just to get a short back on my books. Not necessarily, actually Palantir as a chart looks pretty good compared to a lot of the other ones. I'm going to start shorting the indexes a little bit as well. And honestly, when the market was down 7% the next day, I was like, holy crap. I didn't de-risk enough. I thought I did such a good job of like, wow, I caught this move. Sure, we could get an overshoot on it, but I need to take a half step back. And I still found myself down a large chunk of money at lows on that Thursday, even having taken an awful lot of long risk and added on some short exposure. So now this morning when we gapped up, I was like, all right, I'm doing the same thing. Like, I think we could overshoot to 560, 570 in the SPYs, but I don't mind bleeding out some P&L and some shorts on the way up, because I've got longs on that I can piece out of as well. So it's certainly a tricky market. It could change anytime based on new news, new headline, a new tweet, whatever. But for the moment, the read through here is that growth isn't looking good for the United States, and it's hard to be a really big picture bull looking for all-time highs right now. So you just have to manage the movements as they come.
All right. A lot of the talk last week for the market was that it was so much more about what was happening in the bond market than anything else. Bond market appearing last week to the word I kept reading on Twitter and everywhere was something is broken. Something is very broken with the bond market in a way. This market, it's reacting to the moves in the equity market. Typically large drops in the equity market, people flee to safety, buy bonds, yields go down, et cetera, et cetera. We're seeing very much the opposite. It was like risk off of everything that the U.S. has, equities, bonds, et cetera. Today's action looking a little bit more normal. Yields are down. People are buying bonds. Do you think something's like long-term broken in the bond market, or just, obviously a lot of foreign countries hold our treasuries in the U.S. So do you think it was just a lot of foreign countries dumping treasuries because they don't want them if we're going to be tariffing the world?
So it's something that we have to monitor very closely. The direct answer is I'm not 100% sure. I think it was a confluence of factors that kind of all hit at the same time that led to that selling. Part of it, I do think, is that foreign participants in U.S. markets are not as interested in being involved with us anymore. You see that in some statistics right now at the equity market. They're doing some selling in the bond market. I'm sure of it. I think that foreign governments own like $4 trillion total worth of U.S. treasuries. So there's certainly something to sell there. I think China itself is a little bit under $1 trillion. So they can definitely sell. And I think that some selling there has occurred as foreign countries and investors have just lost faith in the U.S. government and U.S. markets. But I think that like many movements was added on to by hedge fund selling. So one of the things that's really interesting about a bear market is in like more of the earlier stages of a bear market, a lot of the times you'll see rotation. So money's coming out of equities, but they're buying treasuries as a safety play. They're buying maybe gold as a safety play. But then at a certain point, when the bear market gets much, much deeper, people need to raise cash from wherever they can raise cash from. If you're getting a margin call on your equity account, that might force you to sell that gold that you had originally bought as a safety play, or those treasuries that you had originally bought as a safety play. So I think that some of it is probably foreign governments who are losing faith in the United States, but part of it was also just hedge funds having to sell some bonds to raise cash. And also it seems like there's, and I'm not super knowledgeable about the trade, but there's some sort of bond arb trade that I guess is constantly ongoing in treasuries that I think was kind of blowing up a little bit. That was also leading to a lot of margin calls from bond traders itself. That was also leading to that selling. So it was several factors kind of hitting all at once. What I always say about when you're looking at the bond market or when you're looking at currencies, when you're looking at the dollar, is sure, the absolute interest rate matters. But what I find matters even more is the speed of movement. It's always destabilizing, broadly speaking, when you see bonds start moving really, really fast in either direction. A really fast down move or a really fast up move can just kind of be destabilizing for everything. And it's the same thing with the dollar. So I'm paying attention to the absolute rate. I think if the 10-year starts to go past 4.75%, you might have a problem, and you might be getting closer to the spot where the Federal Reserve begins to act to kind of save the bond market a little bit. But I'm also just paying attention to the speed of the movement, because that movement that we got in the TLT, which is just the ETF that I like to look at just for a quick snapshot of what bonds are doing, went from $94 to $85 in 5-6 days. That's a very, very, very fast move for the bond market and for interest rates. And it's not supposed to be that way. And it may have been that the Trump pivot came more from the bond market than it actually did from the stock market. Yet even with that, the TLT managed to make new lows on Friday, even with that Trump pivot. So we're not out of the woods yet, though we have improved a little bit from where we were on Friday's lows.
I want to ask you about a name that is up 444% today. Bull, B-U-L-L. It's Webull stock. It went public via a SPAC on Friday. I haven't talked about a SPAC in the COVID era. They're not a thing anymore often. So Webull, B-U-L-L is the ticker. Any thoughts on this move today?
I had a couple traders when this was in the 40s asking me if they should start shorting it, and I said definitely not. Mm-hmm. We're seeing some crazy movements still in some of these like recent IPOs, and I know that this one is a SPAC. I mean, we had that Newsmax go completely insane like a week ago. I don't remember what it IPO'd at price-wise, but they opened it at 14, I guess, on the day of. And by the next day, it was at 265. Now, I can tell you with a good degree of certainty that Newsmax as a company does not belong at $265. But when you're dealing with the restricted float of a recent IPO, they can go crazy. I mean, does anyone remember, was it HKD? This insanity that probably put people out of business. the hell did this thing do? I mean, this thing was I don't know, $13 stock, and then like a week later it went to 2,555. Does this company even have a business? Like it was just the most ridiculous thing ever. So I can look at a Newsmax, and people were asking me about this on the second day. I can look at Newsmax at $140, and I can say with good confidence, at some point this thing is going to be trading below $140 because the company doesn't belong at it. It's not worth it. But is it going to go to 500 first? In this case, it went to 265 first. So if you started shorting Newsmax at $140 because you think that the recent IPO is overvalued, do you even have an account anymore when this thing's at 265? So when it comes to Webull, I actually think that Webull is a decently legitimate company. But does it belong at $74 on the day after it actually SPAC'd? Probably not. But am I going to jump in front of like a low float recent IPO or recent SPAC in this instance because I believe that it belongs lower? Absolutely not. I have no idea where this thing's going to stop. Maybe it stops at 265 like Newsmax. Why not? Let's just make up numbers. 500 at 2,000, 2,555 like HKD. Maybe it stops right here at 72. I have no idea. But the bottom line is these things can be very, very tempting, I think, for traders to want to short because they're like, oh, this is ridiculous. It doesn't belong up here. And you could blow up your entire account trying to short them. Just wait for the dust to settle, or at least wait for a signal and put the trade on and have a stop loss out and respect that stop and manage your risk to it. Because fine, if you tried to short this at 40 and you got blown out at 43 because that was how much you risked, fine. But if you shorted this at 40 and you think it has to go down and you're still in at 73 and now you have a problem, well, you're going to have an even bigger problem if it goes to 265 before it eventually declines. Something just happened. Market's moving. Something just happened. Just got a nice big uptick here in this 5-minute bar.
Yeah, totally. Oh yeah, definitely. Wow.
Anything else for me today? Because I got.
I think I'll let you get back to the market. On that note, everyone can see how Derrick's seeing everything move in real time. If anyone would like to get Derrick's free ebook, you can go to t3live.com/DOLive. It's about the benefits of prop trading. Remember, Derrick is a real trader, so we're gonna let him get back to that because exciting when things are actually happening. And as we know from the last week, anything can happen in 20 minutes. So good luck, Derrick. Have a great rest of your week, and we'll talk next week. It is a short week. Friday, the market's closed.
Yes.
So everyone remember that. All right. Bye, Derrick.
Thanks, Greta.